Well, welcome to Women on Wealth. This is episode 94. I'm your host, Julina Ogilvie, and today we're going to dive into a topic that I believe stirs a lot of curiosity, a lot of confusion, and that is going to be all about annuities. And you have probably heard them as a way to guarantee income for life. But the question that we always get is, are they really as good as they sound? And we're going to pull back the curtain on what they are, how they work, and whether they might be the right fit for your financial goals. And so joining me is my colleague at Principal Wealth, Glenn Zavorskas, who has been in the industry for over 15 years. Prior to becoming a financial advisor, he was an annuity specialist serving financial advisors as a regional sales consultant at one of the largest retirement and insurance companies in the world. So I could think of no one better than to have this conversation because he can give us the real talk. There is no fluff, there is no sales pitch. We are an independent firm and we're very proud of that. And so this is going to be just about the facts and the insights to help individuals make a better sound decision for their financial future. So Glenn, hi.
Hello, Julina. It's good to be with you.
Thank you so much for joining. And I know that you and I were joking about this. We could probably run this podcast for hours talking about what annuities are, which I think would bore the daylights out of everyone. So I think instead we're going to kind of do like a rapid fire, if that's fair to say, on what these annuities are and whether they make sense for anyone. So
Yeah, I think we'll kind of cut to the chase. We'll look under the hood a little bit.
yes.
We'll get specific on a few items, but for the most part, we should be able to, at least cover a lot of the high level items.
Okay.
Clients that clients should know.
And before we start, I'm gonna throw you because this was not a prepared question, but I'm just so curious because you and I have a similar background in that we served financial advisors in our career for so
Mhm.
long. How would you say your role with a financial advisor was in terms of educating them around annuities?
Yes, because they're quite complex financial products. I was employed by a major retirement insurance company. And my job was in a specific geographic area was to assist advisors in how they position these complex financial products into their clients' portfolios.
Great.
So for me, it was, my first 8, 9, almost 10 years in the business. It was a great way for me to, first of all, learn the business in its totality.
Yeah.
And number two, just see how the financial advisor works at the same time.
Yes.
And
That's
in this
great.
case, you get specific. You get to see how portfolios are designed. You get to see a lot of that financial planning process evolve. And where annuities would come into the picture is obviously looking at risks that every one of us faces, all of our clients faces, which is longevity risk,
Yes.
um, and obviously maintaining a prudent portfolio allocation that's going to serve the long haul.
I love it. And I think that it's important for listeners to know that this is a complex topic and that you
Yes,
had to educate financial advisors as well. So there is no dumb question when it comes to annuities. Is that fair?
absolutely none.
All right.
Cover,
So
you gotta cover it all. That's
let's
uh,
let's
that's
so
the
let's
that's the
start with the
main
most
point.
basic question. What the heck is an annuity?
Yeah, that's the message today. So what are they? And I'll try not to go too far, as I mentioned, under the hood. But your 50,000 foot view looking down answer is it's a financial product and it's an insurance policy that binds you, the annuitant slash insured, to a specific insurance company.
Mhm.
So the terms are typically a guarantee of steady income, tax deferral in exchange for a lump sum payment
Mhm.
or a series of payments. Regarding more of the terms of the contract, we'll be sure to get into this as we go.
Yep. No, that's great. And there's different types of annuities. So can you talk a
Yes,
little bit about how they differ?
of course. I'm gonna keep this to three main annuities that are being sold, Julina,
Okay.
these days.
But there's more.
Yeah, there could be. I'll start by saying by just a few industry comments, I pulled up the 2024 cumulative annuity sales amongst the industry, and LIMRA is basically the tracking source of all of this data.
Yeah.
So across all platforms, whether it's insurance companies, broker solds, either way, the long short of it, there was about $430 billion worth of premium in the annuity industry in 2024. So that's a large number.
Yeah. Is that growing?
That's
Do you know?
and it's growing.
Yeah. Okay.
Just last year from 2023 to 2024, it was about approximately about 13% growth from 2023 to 2024.
Okay.
But to answer your question, now amongst that huge number of sales that occurred last year, what types of annuities, what kind of annuities are out there?
Yeah.
You have your basic fixed deferred annuity, which the insurance company is going to say, okay, for X amount of years that you're in this policy, you're going to earn a fixed rate of, let's just call it 3% or
Mhm.
4%,
Yep.
right? Typically in line with where the interest rate environment is.
Okay.
There's no investments, no mutual funds that you can be allocated in. It's a straight tax deferred growth rate of 3, 4%. And assets are held with inside of the general account of the insurance company.
Okay.
So no market risk, and the only risk that a contract holder would have is obviously the solvency of the insurance company.
Right. Okay.
Secondly, and these were much popular when I was in the industry, is variable annuities. Okay, so they can get a little bit complex here.
Mm-hmm.
So variable annuities are tied to the market, and the client has the ability to select some mutual funds or sub accounts that they can be invested in,
Okay.
hopefully in line with their risk tolerance as well.
And Glenn, those investments can be fixed income and equity, correct?
They can be fixed income and equity.
Okay.
Yes.
Yep.
Yes.
Okay. Got it.
So here you have, a few additional nuts and bolts in play where you have the insurance portion of the contract, which the insurance portion of the contract is a principal guarantee of a death benefit, right? Similar to life insurance called.
Okay.
You have that investment piece, which I just mentioned. You can invest in stocks and bonds, but then you also have the ability to apply optional riders as well, like a living benefit rider or a death benefit rider. So again, these insurance companies will have certain terms of the contract that a contract holder would adhere to, which is mainly a contingent deferred sales charge or a surrender period. Again, when I was in the industry, it could be anywhere between, let's call it 4 and 10 years
Mm-hmm.
that the contract holder needs to be in the contract.
So Glenn, the reason that you're saying these CDSCs vary from 4 to 10 years is because every insurance company creates these policies a little bit different. Hence a lot of the confusion.
That's correct. So an example of that, Julina, example of that surrender period I mentioned is, well, hypothetically, the client says, hey, look, I need to take X amount of money out during that period, or I need to take my full contract or cancel my full contract right then and there at once. There will be a certain percentage penalty. And typically that percentage scales down
Down. Yep.
as a contract gets older.
Yep.
So surrender penalties will decrease year over year over year.
Yep.
But then again, it's still a penalty. It's still an added risk that a
Got it. Nope, that's
contract holder
great.
has. Yeah.
So you mentioned the fixed deferred, the variable annuity. What's the third one?
This is definitely attributing to a lot of the sales and the sales growth of the industry, and these are actually fixed indexed or fixed index linked type annuities.
Yeah.
Again, highly complex. They still hold a lot of the structure of variable annuities where you have a surrender period,
Mm-hmm.
you have the ability to invest in something.
Mm-hmm.
In this case, it is directly linked to a market index. Let's
Okay.
use the S&P 500, for example. So the insurance company is going to say, okay, you can invest in the S&P 500 in a couple different ways. You can invest in a 12-month, monthly average. You can get capped on the upside. You can have a floor on the downside. So obviously, there's risk in what you're giving up. If you're going to
Hmm.
give up growth on the upside, look, the S&P was up cumulative, what's the number, Julina? 47% over the last 2 years.
Yeah,
So again, the client can risk giving up a good amount of upside, but perhaps clients or contract holders like reassurance that there is a floor underneath them, that if, the S&P is down 10%
yeah.
any given year, these are marketed as you will never lose money.
I
However, a lot of upside can be given up.
I feel like it's the analogy of bowling with bumpers.
Right.
Yeah.
And
The
at the
same
same
feel.
time, so yeah, basically this is like the buffer style. We see
Yeah.
them, obviously now, Julina, even like the ETF world,
Yeah.
where a lot of them have been out there. But again, you're limiting your upside and just buyer beware. A lot of times these are sold saying, look, you're not going to pay a lot of fee, you're not going to pay a large fee for this type of contract. Oh, and by the way, you're not going to lose any money. But then
Right.
again, you just have to, granted, hopefully you're working with a good advisor who understands, your risk tolerance, and the history of the market as well, where you're
Yeah.
not going to be limiting a lot of that upside in the future.
No, and I think that's a great point because that kind of led into my next question about these common misconceptions. And I think one of the big ones is the fees.
Yeah, agreed. Most of these times they'll be marketed as no fee
Hmm.
or low fee. Well, look, an insurance company is always going to charge a fee for a principal guaranteed death benefit, right? Because that is,
Sure.
in other words, the insurance
Hmm.
that a client is paying for.
Insurance
An
is not
annuity
free.
gives you the ability to transfer the asset to an heir, to a
Yeah.
beneficiary, and there's always a cost to that.
Yes. Okay. So the cost can possibly be one of the drawbacks. Are there other drawbacks and can you talk about maybe some benefits as well?
Yeah, we
From a high
discussed
level.
we discussed the illiquid nature of annuities, as I mentioned, as we discussed with the contingent deferred sales charge and the surrender periods.
Hmm.
They're not liquid products. Fees we discussed. You gotta, in that case, you have to always understand, what's the trade-off? What am I giving up if I'm being sold something that's marketed as
Yeah.
no fees?
Yep. Okay. That's great. And what about some potential benefits?
Yeah, so some potential benefits would be, look, if you're uninsurable, if you've been denied life insurance
Mhm.
and you have a portion of your investable assets earmarked to transfer to the next line or another beneficiary, an annuity can work. There's no health suitability requirements for that.
Right.
There's no medical suitability as well. So, in that case, an annuity has that assurance that your principal guaranteed death benefit is there.
Hmm.
It can even be more if invested in obviously mutual funds and the market performs well. The basic death benefit of annuity is account value or your principal, whichever one of those two is great.
Okay, great. And I think your answer is so important because the majority of conversations that I have with around annuities, and I'm sure you are as well, when you ask a client, why are you in this annuity or why are you considering an annuity, this is not normally one of the benefits that comes up. Is that fair?
Correct.
Okay.
That's correct. Yeah.
All right, so Glenn, you mentioned riders earlier, and there's a lot of these features in these annuities which create the complications.
Yep.
Can you talk about living riders specifically?
Yeah, living benefit riders, these insurance companies for an added expense or a fee, and again, depending on the offerings of the insurance company, they can provide a living benefit that can guarantee a growth rate. It can guarantee a market step up, which again, you're going to be allocated in a portfolio. If the market does grows by X amount on a monthly basis, on a quarterly basis, on an annual basis, you have the ability to step up your account value or that income bucket in which that compounded growth rate would continue to grow off of.
Okay. And
So
are these
again,
step ups normally once a year, multiple times a year, or does that
great
also vary?
question. Back in my day, there were daily step-ups that were offered,
Wow.
monthly,
Hmm.
quarterly, and annual step-ups. But great question, Julina. And along with that market element, with that market step-up capability, the insurance company would also provide a reasonable growth rate on top of it as well.
Got it.
So one last point with the market step up and the compounded or simple rate of return that that income bucket provides for.
Hmm.
Um, Another misconception, Julina, is that this is not a cash out value. Um,
Great
this
point.
this growth bucket that you have aligned with your annuity or inside your annuity, this is solely for the purposes of lifetime income. So it's a phantom value. The
Got it.
client can't call up and say, oh wow, this contract has grown by 5 or 6%
Right.
for a couple of years. Oh, we got a couple market step ups in the prior years. That value looks a lot more than my portfolio value, so I want that. So a client cannot obviously take out the full lump sum of their living benefit or income base value.
Okay.
That is solely for the contract or the rider to dictate your future lifetime withdrawals.
Great. No, very important point. So thank you. And the question that comes up all the time is how are these annuities taxed? And is
Yes.
there a difference during the accumulation phase and the retirement phase?
There is. As always, Julian, I'm sure you've said this a lot in your podcast. Consult with your tax advisor or your
Yeah.
CPA or accountant who you work with.
Yep.
But I'm happy to kind of delve into the fine tune or the brush strokes of the tax code here with annuities. A benefit to annuities, at least the time being, is that these are tax deferred financial vehicles. So if you have taxable monies or non-qualified monies, your portfolio can grow tax deferred. You won't
Right.
receive any 1099s throughout the years. You won't be taxed on any of that money until you take it out.
Like an IRA.
Bingo. So for all the years that you do get the tax deferral, once you take the money out, the money is taxed or gains first. Your capital gains are taxed first. I
Okay.
should say gains first at your ordinary income level.
Got it.
Right. So if you're invested, let's just say you have a taxable account with Julina and I, and not an annuity, and you look to take money out, well, you would be taxed at the more favorable capital gains tax rates.
Correct.
So again, something to be very, very mindful of, whether you're using qualified dollars or non-qualified dollars, they're going to be taxed at ordinary income.
Okay. Great. And when should one consider an annuity? Another popular question.
Not quite for the younger folks. Typically annuities are going to be sold to pre-retirees, a set of clients that you would see look at annuities if you're looking to create a bridge between retirement and starting your Social Security.
Okay. That's a great point. And we talked about fees a little bit, but let's dig under the hood a little bit more. What are some of the fees that are typically associated with these annuities?
So stay with me here because there's a few components.
Hmm.
So your base mortality and expense charge, or M&E for short, typically runs in conjunction with the surrender period.
Hmm.
All right. So the shorter amount of surrender period that an annuity would offer, an insurance company would offer, typically comes with a reasonably higher cost. Let's say if it's a 5 or 6 year surrender period annuity, like a chassis, if you will.
Yep.
You can have annuity chassis that have a little bit further on surrender periods, 8 to 10 years, and obviously the cost for that would be a little bit lower.
Hmm.
But let's just say hypothetically, an average, you're looking at about a 1.5% mortality and expense charge. That's just a base fee for an annuity.
Hmm.
And again, that 1.5% would cover your principal guaranteed death benefit. So
Yes.
essentially the insurance charge,
Yes.
right? Mortality expense is just basically, part of the admin
Yep.
aspect. If you were looking at one of these kind of flashy living benefits, right, they provide the market step ups, the guaranteed growth rate for purposes of lifetime income.
Hmm.
Your average is going to be about a 1 to 1.25% for that optional rider.
Okay.
The last component is, again, if you're invested in if you're utilizing this, this doesn't apply to fixed annuities, but again, if you're using an annuity that has investments in it, mutual funds or any one of these index linked products, there's a cost for the investment as well.
Yes.
Sub accounts, mutual funds on average in the insurance company wrapper, it's typically around 1%, call it.
Right. So is it fair to say I'm talking to a couple right now and the conversation started, hey, Julina, we've been invested in the market. We're in these annuities for years. Why have we not seen return? And when we looked under the hood and we looked at the fees, their fees were about 3%. And
Right.
so it was eating away the return that they were achieving in the market. Is that common?
That's common, and it's probably a little bit more than 3% as well.
I'm trying to be nice.
Yeah. So here's another thing that contract holders or people who are looking at them currently, they see a write-up in a newspaper or a magazine, or hear somebody on TV talking about them. The one thing you really have to consider is, or one of the things that you have to look at is you're being charged, let's just call it somewhere in around the 3.5 to 4% range, and that's every single year for the life of the annuity policy.
Hmm.
A few years go by and you want to take the 5% or the 6% distribution, guaranteed distribution that the insurance company is going to provide, or at least
Right.
allow you to take.
Yep.
You put both of those together on an annual basis, your drawdown on your annuity policy is going to be, let's just call it 8, 9%,
Yeah.
somewhere around there, right? And that's
Yeah.
an annual drawdown. So
Absolutely.
that for life benefit turns into you kind of starting the year down 8.5, 9%.
Yep.
So the portfolio again can potentially be eroded much quicker than if you were just invested in mutual funds outside of the annuity.
Yeah. Thank you for going through that because to your point on this, a lot of the conversations that I think we as financial advisors have are with clients or prospects that have these annuities that don't quite understand why they're in them and how they work. And so a lot of times we get the question, can I get out of it? What are my options? Can I
You can,
transfer it?
yeah. You
It-
can transfer these. You can transfer them to a product. Let's just say your needs change, and company XYZ is providing a different benefit, something that is more useful to you now going forward. Well, the IRS allows a 1035 exchange where you can go from insurance company ABC to insurance company XYZ
Mhm.
to initiate a new contract, in which the new contract, again, be mindful, is going to start their own surrender period
Right.
or their contingent deferred sales charge period. So you have that option.
Yep.
We talked a little bit about the T word, right? The taxation word.
Hmm.
If you think to yourself, okay, I just want to get out of this thing. I'm out of surrender. I want to get out of it, but the contract has done okay, and you have a gain. You're going to be taxed at ordinary income on that gain.
Yep. Okay.
So a few items to consider if you're thinking about a drastic move like that.
Right. But there is the option if you're out of the CDSC to pay the taxes and you
Right.
could
But
move it
let's
to.
hy- yeah, let's hypothetically say you're still in you're still in that surrender period.
Mhm.
Most, if not all, insurance companies will allow you to take a 10% free distribution out
Great
based
point.
on
Yep.
your market value. So
Yep.
there is some liquidity component if you were looking to repurpose those funds for any reason.
Okay. And what are some key questions that individuals should ask if they're looking at these annuities?
Great question, Julina. Annuities are sold. They're very, very rarely bought.
Hmm.
So if you're looking at an annuity, you must work with a broker to get these types of products. And wherever that broker is, their firm would have certain suitability parameters, which are done at, obviously the firm would have a compliance and a risk area, and they'll assess the need. They'll take a look at your total aggregate investable assets, your net worth. They'll look at
Mm.
all of that to make sure, or at least from their lens, make sure that you are a suitable candidate to
Yeah.
get an annuity.
Yep.
But one question that you should ask your broker is, can you tell me what you're getting compensated on for recommending this purchase?
Hmm.
Why are you recommending XYZ insurance company over ABC insurance company? And then, the potential client, ask yourself, what are you looking to accomplish with the annuity?
Yes.
What will it accomplish? Will it help you reach your goal? Will it help your income, further and further through, your runway of retirement?
Hmm.
And again, consult with your tax advisor or CPA or accountant if you're working with one.
Yeah.
What impact is it going to have on my future taxes? But
Yeah.
also, what tax impact can it potentially have on my heirs as well?
Hmm.
Okay, because again, these annuities don't pass on to the next heir in an efficient manner. The
Yes.
beneficiary will be taxed at their ordinary income levels as well.
Okay.
So again, ask yourselves a lot of these questions, before you make the jump into one of these financial products.
And this is going to be a biased response because you and I work for a very independent firm. We don't sell anything, we don't sell product, but I think that it would be fair to maybe ask the broker or advisor, are you an insurance agent? Is this all you do? Or are you a broader financial planner? Is this part of my financial plan? Does that, am I leading you on to this? Into this
Yeah.
answer?
No, of course. So I mean, again, yeah, as myself being a certified financial planner professional, I'll keep this one really simple. Your financial plan is extremely important. And if you're working with a broker before you make a commitment to an annuity or a financial product, like this,
Mhm.
these tools and resources, these financial planning tools that we use for our clients, they'll give you that answer.
Yeah.
They'll kind of guide you if they're going to be useful financial products for you in the near term, or if they're going to be detrimental to the future in your long runway of retirement.
Yeah.
This is your best resource. As advisors, one of the items we solve for is gauging how long your investable assets would last you and how much you'd pass on.
Yes.
It's really that straightforward.
Yeah. And you sort of just led me into the last question, but I think you and I are, again, the financial planning is such an important part of our firm.
Exactly.
So if hopefully listeners can hear the passion about the importance that we put on that piece for our clients. I'm going to ask you one last follow-up question to sort of end with. Have you ever recommended that an individual put 100% of their investable assets in an annuity?
Absolutely not.
Because we see it all the
Um,
time.
Absolutely not. It's, again, there's that liquidity factor. Part of your investment assets should be liquid. They can be used as emergency savings, things of that nature. Tying up your assets in illiquid products is just not a good recipe.
Yeah. And then, of course, the question that always comes up after that is, well, then how much should it be? And maybe that's circling back to your point of, well, that's where the financial plan fits in,
That's
right?
where the financial plan fits in. And just through my experience of obviously working with the largest firms in the United States, the largest firms on Wall Street, typically you would see suitability departments that do their job, in a prudent way. Typically, you should not be allocating any more than 25-30% of your investable assets to an annuity.
Okay. Somehow I still see it come up. So I think that that's a really great point. And I'm hoping that the listeners are were able to take away some key points of the annuities because again, I think our intent today was not to say that annuities are bad by any means.
Right.
How there are benefits and there are benefits for a lot of individuals. However, we have found maybe in our role that there are so many individuals out there that don't quite understand how they work and end up in these products for the wrong reasons and then struggle to get out of them, right? That's a conversation we have all the time.
Yeah, exactly right. It's just a matter of doing the most due diligence as you can, even if you work with a broker that has discretion,
Mhm.
over your accounts. You still owe it to yourself to do the due diligence, make sure things are being done the right way, making sure that you have full disclosure of what you're getting yourself into, because it can impact you, it can impact your retirement in a substantial way.
Yeah. No, that's great. I will end by saying this. And a lot of my clients that know me know I love to say I'm not an insurance expert. That is not my background. I always kind of hesitate when I hear that, and I always tell them I have these resources at my firm. That's why, we have so many different successful advisors that have different backgrounds, and I'm able to lean on individuals like you. So thank you, first of all, for being there for me personally. And
Yeah.
I'm thrilled that we can share your knowledge and resources with the broader community. And thank you for doing that today.
Yeah, of course. Thank you to all the listeners for hanging out with us for a little while. We could have gone. Julina, we got through this pretty quick. The topic of annuities we can cover for like 2 to 3 hours.
Yeah, it
Maybe
didn't
maybe
start
this is
there.
volume one and we'll do volume two down the line.
Yeah, maybe we do that. Awesome. Thanks, Glenn.
Thank you.